Alrighty guys, so in this video we're going to be backtesting the ICT macros. In specific, we're going to look at the London session macros. If you haven't checked out my other video, I've done one on the New York session macros, but let's get straight into it. So what we're going to do, we're going to go back to Friday and we're going to backtest the whole week. And we're going to backtest the macros just before Silver Bullet, right? So we're going to backtest the Silver Bullet macros today. So what that's going to look like is it's going to look like 250. So that's the first one, 250 until 310 is going to be our first macro. And the second one we're going to look at today in today's video is 350 up until 410, right? Just to see how price action delivers, right? So we're going to try and merge two concepts here, one being the ICT Silver Bullet, but also the macro. So I've just separated the market with two vertical lines here, 250 to 310, 350 to 410. So during this macro, have a look at what price does. Yeah, we do push up a little bit, but I want to point your attention to what's been formed prior to the macro, right? This swing high, this swing high, this swing high, this swing high. Notice that all these highs, they're all liquidity points. They're all buy-side liquidity points. So essentially, when you're taking trades during a macro or trying to frame a trade during a macro, you've got to keep in mind what the market either has already done or what it should do based on concepts of liquidity. So during this macro, we have an internal rate of liquidity right here. So you can see that. We take out this swing low. We do take it out. We reject it. Then we inverse this bearish gap right here. You can see that, right? So how could you execute using this macro? Well, you could execute using an inversion fair value gap if you wanted to, right? That could be your entry there. Stop loss below this candle. Why? Because that candle should be protected, or that body should be protected as well, because we've taken out liquidity there. So you enter from that inversion fair value gap if you wanted to. And where do you target? That's the question that you got to have and ask yourself. So all these liquidity points, right, depending on your nature, that could be a target. Anything above could be a target if you wanted to as well. Or you could even look at this previous range from this high to this low and see where the optimal trade entry is, for example, or where equilibrium is. So if I just get this whole range, right, that whole range, then I add in these two values there too, right, you could take some partials after this high somewhere in this range too, right? So it's up to you how you take partials, but ultimately you need clear liquidity targets. So you can see during this macro, we've rated liquidity, it provided you an entry to go long, and there are clear liquidity targets that you could have entered from. Let's assume you didn't like that macro, right? Let's assume you wanted to wait till the next one. Well, let's have a look at what we do here. We come down, we sweep this low. Notice that, we sweep this low. And what we do, we tap into this candle, which is your order block, right? So we tap into this order block, which is quite interesting. Bullish order block, rate of liquidity. That there could be a total soup entry model, right, after having an inversion fair value gap here, because what you see now, price is just swinging. Now you might ask, well, why is it doing that? I'd consider this move a Judas swing. I'd consider this a little Judas swing. The reason for that is because if we look prior to what's happened with price, look at all the buy side liquidity, guys. Swing highs, swing highs, swing highs, swing highs. All of these swing highs are low resistance points, especially 1, 2, and 3, right? It just seems like that's a trending market. We're going to come and take that out at some point. We get that abrupt movement. We get that abrupt movement here at the start of the macro. The macro sweeps liquidity. We have an inversion fair value gap. That could have been your entry, right? So we created the inversion. You could have entered here. Or price actually came back down and traded into it. That could be your entry to go long. Where do you target? Anything in this price leg that's in premium, or this swing high here. Now, let's assume you don't like that entry. Wait until the macros actually happen, and then as price returns back, see these up close candles, you may want to consider that as your breaker, right? You may want to consider that as your breaker block, because we've rated liquidity here. The last up close candle, we return back down into the breaker and also into this bullish fair value gap here. So you can use the macro, what's happened during that macro, to then execute after. So there's many ways to use the macro. We also rate liquidity here, and we've generated this trend line liquidity. And you can see how we trade past it. See that? We just propel through it, right? We generate more liquidity here, we propel through it, right? So you can see how the market moves in these cycles. And this is purely, right, this is purely the silver bullet macros, right? But mind you, The macros work at all time frames. You just got to see what you want to see and have the liquidity points to target. We've been running up for so long here. No real opportunities to go short, in my opinion, here. Nothing really stands out to me. Then when you go to this time frame, like, yeah, it's outside of London Open, but notice this accumulation. To me, that kind of suggests that we don't really want to go any higher, and we've also rated this internal liquidity here, right? So that there's another macro, right? And you can see how that starts to deliver. The next macro from 750 to 810, you can see how that delivers, and so on and so forth, guys. So even though, you know, you might try different time frames, you can apply this to your other time frames too. Back test and forward test this. But that was on Friday, I believe. So let's go to Thursday's price action. And let's have a little bit of a look at how price delivered in Thursday's price action. Again, we're going to have a look at the macros around Silver Bullet, right? Just to make it nice and simple, so you can simplify your trading model. Let's have a look at the macros. So let's go from 250 all the way until 310. Now, what have we done here? Yeah, we've rated liquidity, right? We've rated liquidity here. You might say to me, okay, well, yeah, that's your market structure shift, and then you might go for a short position here. Is there anything wrong with that? Well, technically, no. If you went for a short position here, here's the thing. Your question now would be, okay, where do I put my stop loss? And unfortunately, with a short position here from an inversion, you'll stop if you apply the rules of the basic, 2022 model goes above the high. You're only getting like a 1-to-1 risk to reward. Other ways to manage it would be to put it above the bodies or above halfway point of this wick. Now, if I was in this trade or in this trade and you take partials, this level of sell side should at least be a level where you're taking partials or moving to break even. So assume you did that, you should at least get a break even at the worst, but you should at least be able to take some partials here, right, during that macro. Now, after this macro, what happens? We propel upwards. And then let's have a look at how we actually execute from the next macro, or if it actually shows us anything important here. So let's go 350, and then let's go all the way to 410. So the macro does deliver. It does deliver nicely, but are there any entries really from here? For most entry models, not really. So sometimes the macro is going to do something, and then it's not going to give you the entry model that you really like. In that case, you just got to work with what you got, guys. You just got to work with what you got. So you can back test this and forward test this even as we progress further. So you got, 450 here, and then you got 510 here, right? That's another macro. How to use this macro? Ray liquidity, tap into a bullish gap and an order block. Inversion fair value gap. Have a look at this. This is your inversion fair value gap here, right? We come outside of it, we trade back into it, look at equilibrium of this leg of price action. So I'll map that out just so you can see what I'm talking about. Look at equilibrium and look to take an entry roughly around equilibrium. Now, if you don't get that here, then when price returns, maybe you can get an entry there. But this is very choppy price action, right? So the best trades, right, come where the macro lines up with delivery, right? The macro is going to do something important most times. Most cases, it's going to give you an entry before, during, or just after. But sometimes it won't. And sometimes you got to watch the macro just deliver to your targets and give you no potential entry. So you can see here it's quite choppy. Price is chopping around. Nothing that I really like there. So on this particular day, guys, that would be a potential opportunity I see there, right? This is all very choppy to me, right? Nothing really that I like here. Yeah, you might say this is your little breaker block here, little fair value gap that technically we might just tap into, but that would have been the opportunity, a small scalp using that macro, and then potentially this macro, if there was something on a smaller time frame there, if you've got access to the smaller time frames, that could have been an option there. So that there is Thursday's price action. Let's go back now to Wednesday's. So it's something I encourage you to actually back test and forward test, guys. Have a look at it yourself. And more often than not, it's gonna work out just fine. So have a bit of a look here, right? Have a bit of a look here. So we're gonna map out these macros now. So 250 up until 310. And I don't really need to say much there. I think you can see what I'm getting at. This macro gives you an opportunity you've got an inversion fair value gap here, right? Now, if you don't like entering off inversions, there's also a bullish fair value gap here too, right? So you got two PD arrays there. There's an order block here. This is technically an order block. So you could then go, okay, price retraces. I'm going to get my Fibonacci from this low to this high. See if I can get an entry above or below equilibrium. Sorry, we do get that when we pull back. So long position, bang, right? Stop loss below this low. Targets at least these highs here, but ultimately you can see this high here is another target, which was formed during a macro. That becomes time-based liquidity. So for those that are watching, that becomes time-based liquidity. If you're still here, any high or low generated during a macro can be a good target for you. So you can see how that performs. You get over a 1 to 2, like very quickly as well. Potentially in like 3 or 4 minutes, you get that delivery. And then here during this macro, right, this is a turtle soup. So you got 350, right? 350 here, 410 there. This macro raids liquidity, and this would have been a turtle soup. We take out these relative equal highs, and then you can see the macro delivers to the sell side targets. Now, why do you think it's going to go lower here? Well, at this point, look what we've taken out. We've already taken out these previous day highs. So we're just watching the macro to see what it does. Plus, there's all these lows here. There's also Asian session lows that haven't been taken out. So if you're trading the London session, Asian liquidity, buy side and sell side, is always an option to have liquidity targets. And you can see then, right, look what happens here. Once we take out Asian sell side, we muck around for a long time, for a long time. And then eventually, yeah, we start to sell off. When do we sell off? 750 to 810. So again, the macros aren't always going to do something that you want, right? But you've got to anticipate that based on prior analysis. So for example here, if you have a bullish bias, right, based on the fact that, you know, we've been stepping up, we've taken liquidity, we don't really want to go any lower, we've got a higher low here, a failure swing, you might have a bullish bias here, right? If you do, and you're in a macro and the macro gives you an entry, it should increase your confidence in taking the trade. If you are here, you can also execute a trade. You can also do that. Right, but just be mindful that before 3 o'clock open, there's a bit of volatility that comes at 3 o'clock, as you can see, right? So you've got to be mindful of entering just before. Be very mindful of that as well. So that day is Wednesday. 2 macros delivered perfectly, right? Delivered perfectly. Up and then down. Reversal points. So you can see probably by now, it happens more often than not, guys. You know, more than not. And that's all you want to see. When you're trading or when you have a strategy, you want it to happen more than not. That's all you're asking for. So let's have a bit of a look. Very messy. Notice this. Very messy price action. Very messy price action on this day. So having a look. This is another, I think, turtle soup. Potentially during a macro. This macro here from 250 to 310, I can see that's doing nothing. That is a bunch of nonsense. Like very, very choppy price action. We take out this swing high here. When do we take that out? So let's map out the macro here. 350 till 410. Yeah. So this is very similar to the previous day, right? We muck around quite a bit. In this particular day, we've got all this low resistance liquidity. So you might be thinking, yeah, we're going to go down, we're going to go down, we're going to go down. But how can you execute off this, right? Becomes very tricky, right? Unless you're in with the turtle soup, right? Then maybe you can take advantage of that. Otherwise, the market just absolutely sells off and it goes to your original targets, right? Because these are targets, the low resistance liquidity points. So this particular day, obviously, a bit of a turtle soup entry, very similar to the previous day in that second macro. So if we scroll back, that second macro rate of liquidity, and then we just sold off. Similar thing happened here. Second macro rate of liquidity, and then we just sold off. So were there any entries there? Well, it depends on your entry criteria and entry models. If you're involved in turtle soups, yes. If not, potentially no, right? Trend on liquidity, always a massive draw. Let's go to Monday's price action now. Let's have a little bit of a look. So let's go to the 250 to 310 macro. So where are we? 250, and then 310, somewhere here. Okay, cool. So we look at that macro, we've pushed up, we've taken out this level of buy side, this level of buy side already previously, and we failed to take out this high. I'd be curious to know, maybe potentially there was some SMT here. That would be nice. Let's assume ES was making higher highs and NASDAQ was making lower highs. That SMT would be good to see during a macro, right? That would be good to see. Now, does that macro provide you an entry? No, but does it tell you something after? Yes, right? We've got this bullish gap here, and I believe on this day there was a 30-second gap here, right? But essentially we reverse this bullish gap. We inverse it, right? We push back down. We still leave all this liquidity, especially this. This is really low resistance liquidity here. See that? It's like very accumulating, but in a small time span, right? And how you can execute using this, guys, is you can wait till the next macro potentially, right? So for example, there's another one from 350 to 410. So if we just map that out, if you have a bearish bias now because of what's happened here and there's liquidity points to target, 350 to 410 delivers perfectly. We raid liquidity, that's your turtle soup. Entry models, you could enter off a fair value gap right here, right? You could enter off this fair value gap, this bearish fair value gap here. Where does your stop loss go? Well, it has to go above this high here, which should be protected, So you enter a short position from here, stop loss above that high. If you want to really be, safe, you could do that. But you've got liquidity targets, guys. Like this low, for example, would be your low-hanging fruit, but these two lows are relative equal lows. And then, if you wanted to hold a runner on this particular day, you could, right? You can see how we trade down, and it's absolutely beautiful. Right, so what you're looking at doing, guys, is letting the macros frame a trade for you potentially, right? Trusting the macro if it gives you that extra confluence, but seeing how it delivers, you know what I mean? So if you haven't checked out the previous video for the New York session macros, check that out. It's something that I'd encourage you to backtest and forward test. These are going to be regular videos that I make just on the macros every few weeks. But if you like this video, guys, give it a like. If you have any comments, leave in the comments below. And until next time, I'll talk to you then.